All right, guys, we're going to talk about just a quick overview really quickly of perfect, right? Of some investment accounts and things that you can look at to invest in. Um, and before we get started, I want to tell you the best investment that you can make. You ready? This is going to be exciting. Ready? Boom. Get out of debt. All right. That's the first thing you need to do is get out of debt. That's going to be the best return on your income is keeping 100% of your income, right? When I say getting out of debt, I do kind of exclude mortgages because mortgages take a little bit of time, a lot of bit of time, right? That's going to be one of your major ones. But if you don't have a mortgage and you're out of debt, let's move on and get into some investments, all right? And that's including your student loan debt. Try to knock those out as fast as possible. Knock out that car debt. If you have a really high car debt, sell that car, get a beater. I'm with Dave Ramsey on that 100%. Here's a couple of things you need to keep in mind. I'm going to try to fly by this for example, but here's a couple of things that you need to keep in mind when investing. First off, what is my aversion to risk? How do I stomach risk? Am I going to freak out if I lose money? And if that's the case, maybe stock markets isn't for you. Maybe some less or more secure investments are for you. Okay. Two, how much do I understand the investment? How much do I understand the thing that they're trying to sell me, the investment they're trying to sell me? If I can't understand it, then I don't need to be in it. I need to be in something that I understand, all right, that I trust. And if I can't understand it, if an investment person's trying to sell me something, a financial advisor is trying to sell me something, and I don't quite understand it, take a week, look it up. Look it up for yourself, ask some other people, get a second opinion, and then if you understand it, then maybe get into it if you like it. If you can't, then tell them no. It's your money, okay? You need to be able to understand the investments you're getting into. Also, is my money better used somewhere else than where I'm about to invest it in? That's called economic profit versus accounting profit. And if you have my economics class, you've probably learned a little bit about this, all right? Economic profit basically means that if I get into this investment, am I losing money in this investment as opposed to another investment? I might be still making profit here, but am I making as much profit as I possibly can with all the understanding that I have and all the knowledge that I know? Am I making the maximum amount of profit here? If my money can be used better somewhere else, then I'll go that somewhere else. All right. 4. How long has the company that I'm about to invest in been around, and and that's a big deal, because if you're going into some brand new company, if you're investing in an IPO of a brand new company, it may not be, or it's going to be super risky, and it may not give me the return I'm looking for. All right, but if it's been around for a long time, they offer dividends, those kind of things. That might be something I'm better equipped to deal with. All right, how long has the company been around? Lastly, and most importantly, be patient. All right. Investments are a seed, okay, and it takes time for seed to grow. All right, this is a very biblical understanding. All right, it's a very biblical thing. You plant the seed, it takes some time, and then the seed grows. Now, there are times when the seed may not produce, and it might freak you out a little bit, where you might lose some of your income or of what you invested in. Don't freak out. Be patient. Take some time. Take some breather, and then kind of decide there. All right. Next, all right, this is the first thing that everyone thinks about when you talk about money. They're like, hey, stocks. Perfect. Here's what a definition of a stock is, all right? A piece or ownership of a company, also known as an equity or a share. The reason they call it a share is because it's a share of ownership, albeit a very small share of ownership, okay? That means if there's 100 stocks out there and someone owns 51% of those 100 stocks, so the 51 stocks, that person is a majority shareholder and has a lot of say in what the company does going forward. Now, if you only own 2 or 3 of the stocks, you're not a majority shareholder, but you do get invited to the shareholder meetings and all those kind of things, right? It's pretty cool. Now, there are major U.S. indexes or indices that tell you kind of an overview of how the stock market is doing. Obviously, there's the Dow Jones Industrial Average, or the Dow, and you see this all the time on the bottom of the screen of your Fox News or CNN or any of those kind of news channels. And this will tell you if it's up or down, right? You'll see the little red arrow or the green arrow. Green arrow means it's going up, and red arrow means it's down. And when people say the Dow's down this year, this month, or whatever, or today, they're talking about these indexes. Now, that is not it's not a super accurate idea, but what they did was they took several major companies that are kind of powerhouses in their industry, and they put those together in this index. And as those fluctuate, the average between those fluctuates, that's what you see as the ups and downs in the Dow. All right. Now, with those 100 or so companies, that doesn't mean the million or so companies that are traded on the stock are all going down. It's just a good indicator that stock market might be down and you might have lost some money, so you can go and check it. All right, that's all that really means. But it doesn't mean if your sector is not represented very well in the Dow or the Nasdaq or the S&P, then you actually might be doing better than the Dow. And that is actually happens all the time. All right, so don't freak out when the Dow or the Nasdaq or the S&P is down. All you got to do is just kind of look through it and power through it. All right, be patient, look at your stocks, see what's going on, call your broker, call your financial manager and say, hey man, I saw the Dow was down, what's up with ours? We're doing good. Cool. We're down a little bit. All right, what do you recommend? Well, let's just hold off and see what's going to happen within the next few days. I think it's just a small glitch, right? All right, cool. Or a small hiccup, and we're like, all right, good. We'll deal with it in the next 3 days. Awesome. That's how it goes. Now, the stock market game, and I need you guys to get into that. You need to send me the invitational from that, and so that I can get you logged into it. Is tied to the S&P, so we're going to be looking at that, the Standard & Poor. Next is our initial public offering. Now, an IPO, initial public offering, is where the company actually makes money when they issue stocks. So when a company says, I need to raise $1,000, they're going to issue 100 stocks at $10 a piece, or 1,000 stocks at $1 a piece. It doesn't matter. So they're going to say, all right, I think I can get $10 a piece for each of these, so I'm going to try to issue these stocks out and raise money that way and see what happens. So let's say they get $10 a share, right? On that first time, the first 1,000 people who bought it, or however many people bought those 1,000 shares, that is called the initial public offering, the IPO. That's the only time that the company made money. When that happens, you can then trade it on the market, on the secondary market. So if I, Brandon, bought the stock at the IPO, the company made money off of me, but then I decide, well, this $10 stock isn't going to be any higher, so I'm going to sell it at $15 and see if someone will buy it. Well, let's say that Megan goes to buy that stock and says, you know what? I think that stock's going to be worth more than $15 in the future, so I'm going to buy it from that guy for $15. Well, that's what happens. The stock market trades at $15, or stock trades at $15. Well, and Megan gets it for $15. I sold her for $15 and made $5 on that stock, right? Well, the company, the owners of the company, did not make any money on that secondary market trade. They only made money on that initial trade between the company and myself, Brandon, right? That's all that means. But why invest in stocks? Well, the pros are you have super high returns, and some stocks offer dividends, but of course the cons are that you are tied to the market. So anything that fluctuates the market, crashes, weather patterns, anything you can think of can really have an effect on it. So you have a high risk of losing your money. Next, you can purchase your money purchase stocks through brokers. I think Citigroup is a broker. There's a couple of other brokers out there that you can buy stock, and there's also the online stock purchases are brokers like Ameritrade and E-Trade, etc. All right, so those are different ways that you can buy them. Next, we have bonds. Definition of bonds is a legal binding note or a loan, so you're purchasing debt, usually issued by a government or a corporate entity. So what a corporation does is it'll issue out, let's say, a couple of $1,000 bonds out there into the market, and people will buy that $1,000 bond at whatever the coupon rate is. Here we go. So the face value is the $1,000 that they offer. I don't know why I have interest rate and coupon rate here. I'll fix that later. But the coupon rate is the amount that they're offering it for. So let's say they're going to give you a bond that says that they're going to issue you, if you gave them $1,000, they're going to give you 15% over the next 30 years, right? So the face value is $1,000. You gave them $1,000. They're going to give you 15% for the next 30 years. That's the coupon rate. But then, let's say about 15 years into it, you don't like the bond, or you think the bonds are going to go up higher from 15%, which is a crazy high interest rate, by the way. That's no one's offering that I know of. and can be sold on the second. It can be sold on the secondary market. So if I've had it for 15 years, but I think interest rates are going to go up to 20%, I'm going to sell that 15% bond to somebody who thinks it's going to go down. They're going to buy it from me at usually either a premium or a discounted rate, or discounted price, which I think I have here. Yep, a discounted or premium price. Premium would be more than what I paid for at face value, or more than what the bond's going for, or a discount where it's less than the face value, or par value, or less than what it's going for, right? And then so then they'll buy it, that same bond, but the maturity date, which I don't have on here, I should. The maturity date is going to be 15 years from when I just sold it, right? Even though I bought it at 30 years, but I've held it for 15, that means the next person buying it from me will only get interest for the next 15 years. They're not. It doesn't reset. All right. They're just now the ones collecting the income on debt. But some bonds are there's what's called callable bonds, which means that at some point if you're in a callable bond contract, that means that the company or the government or whichever issued that can call that bond, which means pay you before that bond is actually matures, and you lose that stream of income. But those callable bonds usually offer a higher percentage rate because that's more risk on you. Then one of my favorites is the mutual fund, which is an investment where many investors pool their money together to purchase stocks, bonds, money markets, and other investments or assets in their field. So basically what a mutual fund does is, let's say there's a $10 stock in Coca-Cola, but you only have $1 to your name, which I hope you have more, but you only have $1 to your name. Well, you can put that dollar in a mutual fund that invests also in Coca-Cola. What they'll do is they'll pool that $1 that you have with the other people who are in that mutual fund, and now you have a part owner, and that's spread out among all the other stocks that mutual fund has in it. All right, so that gives you less of a risk because now all your money is pooled together with other people, and you share the risk with other people like a partnership or a corporation, and it's also spread among other stocks, so your eggs aren't all in one basket. Another cool thing is that mutual funds are operated by money managers, where it's their full-time job to make sure this mutual fund does well, when your full-time job is to do what it is that you were hired to do, nurse, whatever, preacher, singer, it doesn't matter. You do that all day, and someone else deals with your money all day, which I think is fantastic. The cons are that it is tied to the bond market, money markets, or stock market, and so you do risk the loss of your income. Next is real estate. A couple ways that you can do real estate. I do have some experience not in investing in real estate, but I did sell mortgages, and it was part of a title insurance company. So here are a couple of ways that you can invest in real estate to make money. One is obviously you can rent your home out. You can invest in some properties to rent out to make income there. Where a lot of people fall short or have problems with renting out is they fail to also include in their rent wear and tear. All right, that means if you need in the next 10 years, if you need a new roof, then you need to take that 10 years, divide it by, or whatever you think the price is for a new roof, divide that by 10, then divide that number by 12, and add that amount into your monthly payment. Okay, so the monthly payment that you're going to receive. A lot of people forget that when they're doing that, and they lose their money when something goes wrong. The other way is to buy real estate to flip, and that's basically you buy a beat up house and you fix it up and then you sell it for more than you bought it for. Next, and this is fairly new, is turn your home into an Airbnb. If you're in a pretty hot market, if you're in an area where people will go for vacation, Airbnb might be the way to go, which means you rent it out weekly to different people for however long, and means you won't have a super steady income like you would a renter who signs a 2-year contract, but you might actually make more money, and you won't have to deal with the kicking somebody out if they're doing terrible and not paying you your rent. So basically this is a kind of a safer route in that case, and you can do that on Airbnb.com. The next is the real estate investment trust, or REITs. I'm not super familiar with REITs, but how they work is you basically pull your money together with other investors, and they will buy either mortgages, in which case you will get a portion of the income that they receive, or they will buy actual properties, and then you'll receive a portion of the income from that. And some of them actually mix the two together, kind of a hybrid between mortgages and the property value themselves. Second to last here is owning your own business. Open up a small business. How do I utilize my skill sets? Am I good at nannying? Maybe I put myself there on care.com. Maybe get some do Ubering or Lyft or Uber Eats, those kind of things. Open up your own small business as an investment, right? You turn my car into an investment. Turn my skill set into an investment. Pick up a paintbrush. Get a couple lawnmowers. Do the mulch in people's yards. Whatever it is that you can do to earn a little bit of an income, this is a pretty good and wise way to invest. Another is if you're sitting on a whole bunch of income, or you're sitting on a pretty high asset value, then you might think of franchises, right? Taco Bells, any of those kind of things is another way to get into that. I mean, who doesn't want to own a Taco Bell? Second, partner up with, or thirdly, partner up with somebody. If you don't want to shoulder up all the risk, you can partner with people. And if you, but that means you don't receive all of the reward either. So the risk is less, but so is the reward. Lastly, and I'm just going to do a quick overview of these, just kind of give you a list of them, because we're going to go through retirement accounts and estate planning later. We have the IRA, which is an individual retirement account. We have the Roth IRA, which are the two main individual retirement accounts. IRAs, regular IRAs or simple IRAs, they are taxed on the withdrawal when you retire. So you can add up to about $5,000 a year to this to an account, and that is not taxed. That's pre-tax money. But then you are taxed later when you retire, and that's going to be the tough part, because you don't know what your tax burden is going to be then. You don't know if your income is going to be high enough to stomach that. And so the other way to do it, and this is where I recommend, is doing a Roth IRA, which means you're taxed on the seed and not the harvest. You're taxed on the contribution, that $5,000 a year that you're contributing, and then you're not taxed when you withdraw it when you retire. Next is the Simplified Employee Pension, which is an SEP, and that's for individual people who own their individual businesses. So if you are if you own your own business and you don't offer a 401k, or you don't have any of that stuff, you can get into an SEP IRA. Next is 401k. I won't get too much into this. Remember, we are going to go into retirement accounts and estate planning. But 401ks are offered through your company. These are really good. These are pre-tax dollars as well. Usually they match the contributions that you make. We'll talk about that later. So this is really good. 401bs are exactly like a 401k, but these plans are for teachers, churches, governments, usually any other tax-deferred or strangely taxed workers, usually. And then lastly, there's annuities, which are usually tied to insurance companies that are basically you give them a lump sum of money, and what they'll do is they'll invest that lump sum of money in an accumulation process, the accumulation portion of this, and then at the end of that accumulation portion, they're going to give you a steady stream of income called the annuity portion, an annuitized portion. And so we'll talk more about that in the retirement and estate planning. Cool. I hope this worked. Hope this helped you in any way. If you have any questions, you can always contact me via phone, text, email, etc. And if you have any more questions on those, if you want any more details on any of those, or any help. So I hope God richly blesses you, and that you're great stewards of your money and of your finances, and we'll see you next segment.